Hi there. You might have heard in several news channels, videos, the internet media agencies and so on that
While wages are rising, they're not keeping up with inflation. Wage growth has been consistent with an about 4.5% inflation rate.
Today, consumers can purchase about 2% less than they could a year ago.
Workers are getting paid more, but inflation may have them feeling like they're getting paid less.
When we adjust earnings for inflation, if you look at hourly earnings on a year-over-year basis, they're down 2.7%.
Firstly, we need to take ourselves back to 1929, the year when the Great Depression started and took a hit to the world economy that relied on the US dollar like Germany. So for context, there are two types of banks that operate. One is called commercial banking system and investment banking. Commercial banks act as warehouses that deposit people's money and lend money. Lending money is sometimes called issuing credit or a financial instrument since it carries a liability and a creditor relationship. Investment banks, on the other hand, do not accept deposits. They do, however, issue financial instruments or securities like mortgage-backed securities, stocks, bonds to raise capital for corporations, governments, and other entities. These securities trade on capital or secondary markets. Sometimes they also underwrite securities by issuing shares and selling them at a higher price to investors. Investment banks typically do not engage in low-risk security offering. They engage in high subprime loans like MBS or leverage buyout funds to investors to acquire new companies and pay a higher interest rate to compensate such a risky investment. Investment banks, for this reason, do not accept deposits like commercial banks because these high-risk investments can lead to a default in some of these high-risk securities or loans that investment banks are engaged in financial markets. However, this is exactly what happened before the Great Depression. Commercial banks and investment banks engaged in interbank trade. Commercial banks would loan out or issue depositors' funds to investment banks, and in turn these investment banks would organize these funds in a complex bundle of securities or securitization to invest them frantically, whether by issuing stocks, bonds, and other instruments. Low fractional reserve banking allowed commercial banks to issue more and more credit whilst only needing to keep a small percentage of reserves and loan up the rest of deposit funds, which was allowed for by low interest rates on deposits, whilst higher interest rates or cost of borrowing on capital and secondary markets like issuing short-term or long-term debts. Investment banks like Wall Street would take these high reserves from commercial banks and lend them to investment banks. However, when the stock market crashed in 1929, investment banks could not pay back these securities or reserves to commercial banks, especially when they lent out too much or over-leveraged on high-risk loans to investors which they themselves were unable to pay back. Back then, there was no FDIC, deposit insurance for commercial banks, which meant that the banking system practically collapsed and filed for bankruptcy, and nobody could claim back their money in deposits. Therefore, these people lost their savings, prices collapsed as a result of lower demand, businesses couldn't get loans, unemployment skyrocketed by 25% in 1933, and the world economy stagnated into heavy deflation. Countries that relied on the US currency, especially Germany, to fund its war reparations after World War I and the Treaty of Versailles, suddenly these US loans were revoked in order to liquidate commercial banks into cash assets to compensate its liabilities, but it failed due to no availability of FDI insurance at that time. This, of course, led to the rise of Nazi Germany in 1933, since German commercial banks relied on the dollar deposits to keep it afloat, but then they also collapsed, leading to a decrease in savings and investment. Consequently, the US government stepped in and through the use of the Federal Reserve Bank, which is the central bank of the USA, bailed out these commercial banks, and in order to prevent such an economic recession in the future. They also increased the fractional reserve ratio, or the minimum reserves at which commercial banks should keep in the vault in the central bank as Fed funds in order to contract credit and stabilize monetary policy. The US government also introduced the Glass-Steagall Act in 1933, which made it unlawful for commercial banks to engage in interbank operations with these high-risky investment banks. It also marks the distinction between these two institutional entities. The Fed held excess reserves, which meant the IOER rate, which were higher interest rates on commercial deposits locked in the vault, which could also be lent out to the US government in the form of issuing treasury bonds or reserve repos to compensate for lack of business investment, which resulted in lower taxes. So problem solved? No, not quite. Gramm-Leach-Bliley Act of 1999 repealed essential parts of the Glass-Steagall Act, allowing for commercial banks to re-enter its relations with investment banks, which would lead to another recession in 2008. The IOER rate also decreased, and fractional reserves also significantly lowered as well, which led to another spiral of credit expansion, driving up prices and inflation. Investment banks like Wall Street, which also acted as a commercial bank, would take their high reserves and bundle them into mortgage-backed securities or MBS and make acquisitions of major corporations by purchasing their shares and reselling them at a high market price for profit. However, other independent commercial banks which did excessively leverage on high-risk subprime mortgage securities to homeowners led to homeowners defaulting and the real estate bubble prices collapsed as a result, which made the value of MBS collapse too, since no investor would want to buy these, since the value of MBS was based on the homeowner's ability to pay. Thus began the wave of liquidation and bankruptcy, and the Fed again stepped and injected liquidity to bail these commercial banks, just like after the Great Depression. This, of course, added more national debt to the US government because the government started to sell bonds to the Fed to save the banking crisis. So this whole issue boils down from the repeal of the Glass-Steagall Act, right? Well, yes, but at the same time, increasing the IOER rate wouldn't have been better for commercial banks to encourage locking their reserves in the central bank to prevent such risky behaviour in the future. However, contraction of credit increased interest rates, which encouraged depositors to save their money, which led to a decrease in consumer spending, and thus taxes decreased as a result, especially due to lower investments. The US relies on non-inflationary measures to finance its treasury debt, and without a proper taxing system, the US government can no longer compensate itself without instigating inflation. It does this by selling treasury bonds to the Fed in order to borrow these excess reserves. However, since these are being borrowed, the Fed needs to be paid back the principal with interest, and that is the inflation that occurs. It only serves to increase its national debt, whilst benefiting wealthy individuals who can simply create money via quantitative easing or lending out these commercial reserves. In doing so, it triples the national debt. The government responds by imposing a penalty tax on the private sector like businesses, individuals and households, which hurts them. So, why does this inflation happen in the first place? It's simple. The US isn't a pure capitalist system. It uses money creation and reserves to fund real estate, invest in shares, capital, infrastructure, public sectors which bid up the material costs from suppliers, thus forcing businesses to increase their prices as well. This is why wages in the United States, especially fixed salaries, are not indexed for inflation because of the inherent inflation tax that the US imposes on people. And as long as the US engages in its socialist policy, it will only incur more debt. The solution? Privatise everything and abolish income tax.
Get the hell off me property, hurrah, hurrah. Get a taste of me M60, hurrah, hurrah. My legal wrath is ready now to place a bullet in your brow. And we'll all feel great when money comes marching home.